All right. Good morning. All right, Tony, if you could let me know if you hear me in the video. Let me know in the chat. That would be wonderful. Having some technical issues this morning. All right. But yeah, let me know in the chat if you can hear me okay. It says everything's all right, but I just want to make sure. All right, perfect. Thank you, Tony. Yeah, let's get started by looking at obviously the economic calendar as always. Hope you guys are having a good weekend so far. All right, so we got Fed speech or the chair talking. That's going to send some fireworks. We got CPI on Wednesday. PPI is going to be another insane move as well. So yeah, we got a lot of fireworks this week. Good morning, Eddie. So yeah, we got a lot of fireworks this week. We have CPI, we have Fed, Powell speaking. So again, these are going to send a lot of shock waves through the market. We're in extremely volatile times. I don't know if you guys watched ICT's video the other day, but he pointed out some very important things with the tariffs and how those things are going to impact everybody and the market. So you want to make sure your risk is not so aggressive. Like you don't want to overtrade. You should never overtrade anyway, right? You should never over leverage anyway if you want to be here long term and make this something valuable to you and your families. But especially in times like this. And then we got some stuff in the market that we're going to talk about that we've also touched on over the last 3 to 6 months, just pretty much describing certain conditions and what price shows us when it's doing particular things on that higher time frame, and then how that trickles down to the lower time frame and assists us in identifying high probability, low probability, high resistance, or low resistance conditions. But yeah, so CPI is a one-sided event generally, just for those of you that don't know. FOMC and NFP, those are two-stage events. So it'll shoot one way, fake people out, and then it'll pull back to the actual direction. But like I said, CPI is a one-sided move. Like if you don't get in or find something, which it's preferably, it's preferred to not even engage during CPI because it will rip your face off, and it's just not worth pushing in a situation where the risk is so elevated. Because yeah, you may be able to make a couple thousand here or hundreds or whatever your targets are, maybe more, but then again there's also the downside. So we can't get blinded by ambition and goals and what we want price to do or what we want our account to be at, because if we let ambition take over common sense and like the actual risks in the market and being aware of them, we won't be here that long. We want to be here for a long time, not just for home runs. Base hits will always be more in the long run, in terms of being able to make this a career versus being a home run chaser, right? And only looking for home runs. Otherwise, you get upset or something. You want to make sure your targets are reasonable. And in times like this, January has probably been very difficult for many people. It's typical, right? It's a typical situation for the start of the year to be that way because holiday volumes coming in, A lot of smart money is on the sidelines. They're not really doing much. And then, of course, we have geopolitical craziness going on with tariffs and all these different things. So those have direct impacts on what the market's going to do and what it looks like and how it delivers and stuff like that. So you want to make sure you're able to identify these things, because a very large part of your ability to be consistent in the market and prosper is your ability to have situational awareness. Know when to trade, when not to trade, which is something that we talk about a lot here in my private community, because it's critical. Because if you're in a battle, like in a war or something, okay, you're not just gonna you're gonna want to know what the best mode of operations is gonna be. Like, what are you gonna do? Are you gonna run into the battlefield when gunfire is going off just because you want to attack the enemy, or are you gonna sit like a sniper and pick your shots properly so you can effectively neutralize the enemy? It's the same in the markets. We're out here trying to out strategize people and go against some of the most insanely vicious people that want to take your money. Some of the smartest people on the planet are in this market trying to make money. And then, of course, it's ran by an algorithm that's made to capitalize on human psychology. So you want to make sure you're aware of these things. And again, that just goes back to what I was saying. Knowing when to trade, when not to trade, when to pull back your risk, when to push your edge. All those things are very, very important. And if you don't understand those things, which a lot of times comes from your experience in the marketplace and being able to study the proper ways of doing things, if you don't focus on those things, it becomes a serious problem. And I guarantee you, at least a lot of my private community students tell me this, is if you go back and look at a lot of your losing trades and you go over the rules that we talk about here, you'll see that most of the time you're taking losses outside of the rule parameters. You're pushing on a day or pushing on a week in a particular condition that's not favorable for what you're trying to impose in the marketplace in terms of goals and results. There's a time and a place to do things. You're not just going to want to be a machine gunner, right? You want to pick your shots properly, especially right now, because fireworks are going off across the world with geopolitics and just the fact that it's the beginning of the year, and so you want to keep these things in mind. So Monday there's no news. So generally when there's no news, right off the bat you think low probability, because there's no volatility injections. There's no a lot of times the manipulation is not present. Sometimes it does move though. It's not a every single time sort of thing. Nothing's 100%. But most of the time, right? Most of the time, because we're in a probabilistic environment, if something most of the time acts a certain way, you got to go into those moments assuming that, okay, in this case, if there's no news, since most of the time it doesn't really do much, or it just lacks volatility, we go into that lowering our risk, lowering our amount of trades we take, and just being cautious, because your number one goal as a trader is risk preservation, capital preservation. It's not to make money. If you trade well and you follow your rules and have a very solid plan that you prove over a number of years to be consistent, then things become a whole lot different. So you could be a lot more effective. All right, so that's the news landscape. Again, Monday has no news. We have Fed speech Tuesday, CPI Wednesday. Thursday we have PPI, so it's going to be fireworks all week, I'm assuming. And just expect not much expectations on Monday, right? So let's move on to the next thing that we always look at, right? And that is the interest rate markets. The interest rate markets, for those of you that don't know, dictate where specific assets will go, or they highly influence what particular assets do. The bonds, the bond yields right here, this dictates and influences what the DXY does for the most part, right? And then the bonds, right? The bond futures here, or T-notes, right? This dictates a lot of times where foreign currencies will go. It dictates where the indices will go generally, or influences it. It's not lockstep, but it's one of those influential factors that pushes price and allows for you to trust things and trust your decision making when it comes to particular things taking place in the marketplace. All right, so yeah, for those of you that don't know, these are the symbols for the bonds and the bond yields, right? So make sure you take these down and start studying them because it's vitally important. You see that there's 3 for each, right? There's 3 yields and 3 bonds, right? Or T-notes, right? Whatever you want to call it. And that's because there's sometimes SMT between the 5-year, 10-year, and the 30-year bond yields, or SMT between the 5-year, 10-year, and 30-year T-notes, right? Or T-bond futures, right? And when you're identifying an SMT between the trios, say it's got SMT at the lows here for the bond yields, or there's SMT at there's SMT at the highs for the T-bond futures, right? Generally, that's going to lead you to a turning point in the marketplace. And a lot of times, that type of phenomenon takes place when we are changing quarters, which we will be in March, if I'm not mistaken. So we've got a little bit of time up until that point. So yeah, that's why there's 3, and that's the importance of having the three assets being studied, right? Like you could see here for the bond yields. Oh wait, whoops. Put this, I got an incorrect thing right here. Let me adjust this real quick. Oh, whoops. Wait, that was... Get that back to the way it should be. All right, so yeah, again, let's start with the bond yields today. Again, that dictates where the DXY is going to go. Tony, once I master patience, I will be successful. It'll take time because we use a higher time frame. Yeah, and again, the patience that everyone's trying to aim to have and trust in your analysis, well, patience comes from your ability to trust a systematic process, something that continuously repeats. And that's the beautiful thing about ICT concepts and smart money concepts, or whatever you want to call it. It's all the same. But that's the beauty behind these concepts. There's consistent, repetitive things because the market moves on a algorithm, right? It's all pre-programmed and systematically done, and nothing's random in the marketplace. Everything has a purpose, even on the seconds time frame. It all works within the larger picture of the higher time frame, which again, that's where the big players reside. But the fact that things are so systematic, and the fact that the algorithm is programmed to do specific things and everything's controlled, that allows us to have the ability to identify characteristics in the marketplace that are repetitive. Then that's what separates smart money concepts from everything else in the marketplace. Everything else, if you go look at some of these other people that supposedly think the market is random, the only reason that most of them are successful, in my opinion, and in many other people's opinions that are, decent traders, it's based on their risk management, right? You could flip a coin, and if you have good risk management, you'll still be able to be profitable if you know how to keep the downside minimized and, maximize the upside. But again, if you're going to do something as a career, you want to be able to have some type of certainty. And although there's never 100% certainty, there's ways that can be used, like tactics that can be used specifically in smart money concepts that put the odds heavily in your favor, right? So, and there's nothing else like this in the industry. And that's why this is, in my opinion, one of the best possible things. And smart money concepts, I had a conversation with someone in the week, and they were talking about how smart money concepts can assist any style of trading. Because if you think of the process of power of 3, for example, if you understand the open, high, low, and close of a daily range or a weekly range, but you use stochastics or the MACD or whatever indicator people like to utilize, you can make those things make a whole lot more sense and be more effective if you understand things like the power of 3. Right? If you understand the regressive risk tactics that ICT teaches in his different his risk models, most of the stuff has to do with risk management if you're outside of smart money concepts. But again, smart money concepts can help everybody. But yeah, patience, Tony. That'll come from majority of the time. It'll come from your ability to have a very systematic approach. And I'm grateful that you've been here for a while and you've been able to start seeing some efficacy to a lot of the stuff that we talk about. Not only what I talk about, obviously, but in terms of what ICT teaches. Because he's very flamboyant and very aggressive with a lot of things he does, and you don't have to love the man. You have to investigate the concepts, and that's why his tactics are so insane. Why he looks crazy, like a psychopath, right? Because he's never had to spend $1 on advertising, and he does everything very purposeful. So separate the man from the concepts. If you do end up being new to the smart money concept world, because it can be very very abrasive and push a lot of people away from a wonderful way of doing things in the marketplace relating to smart money concepts. So and again, those of you that spend any time here, right, some people need to see things done outside of the main mentor because of the way he behaves. And a lot of people hate on him and all these different things, but it's undeniable to see so many students from under ICT's teachings that have made so much money, that are on YouTube showing live constantly. Like we're gonna have our first YouTube live trading session on Tuesday this week, which I hope to see y'all there. And you're gonna see, aside from the analysis and the things that we have done, which again, if you guys have spent any time watching the content, you see that there's a lot of efficacy to it, and there's consistency to us being able to call one side or another, and the reasons why we make those decisions, so on and so forth. So it's just very, very important in some people's eyes to see other people doing it outside of ICT, because it's kind of hard for some people to listen to what he says. He's also very complex. He's a computer coder. So he doesn't really all the time put things in the most simple ways. And he's also admitted that he makes things more complicated than they need to be, right? Getting people to the right destination, but he does it on purpose, the over complex ways of doing things. And lately, though, for the last couple of years, he's been trying to change that as a gift to everybody in the trading community because of all the chaos we've had to endure in real life, with all the craziness going on in the world. But yeah, you want to make sure you separate the man from the concepts. If you are new to ICT concepts or want to get closer to it, but you're kind of been stopped by just the way he behaves, ignore the way he behaves and just dig into the concepts, right? And if it helps you to be around people or around communities like this, YouTube channels like this, so you can see it done from other people that kind of disregard the whole marketing chaos. Then so be it. So I'll tell you one thing. I can never guarantee profitability, because that's impossible for anybody. Doesn't matter who you are, to guarantee, because you could give someone the best system and they'll go out and break the rules and then try to blame you, right? So it's personal. You can give someone a hammer, but that doesn't mean they won't go and try to hurt somebody with it instead of actually building whatever the hell they're trying to build, or doing the wrong things with it. That's the same with trading, right? You get all these different tools, all these different things that have proven to be helpful to other people, but it's up to you to apply the things properly, and do things correctly to make it effective for you as well, and that's why trading is so frustrating to some, because they'll see other people doing the same exact things and being profitable and successful with it, while they sit back and struggle with it, the exact same process. And most of the time has to do with them breaking the rules, lacking risk management, trying to hold longer than they should, not allowing their stop to be taken. If it's getting taken, they try to extend it all the time and increases their risk, over trading, and just trying to do things their way when they don't know what they're doing yet. So you can be very custom over time, because once you understand the elements and different pieces to the process, for whether it's bias, whether it's risk mitigation, whether it's targeting, whether it's navigating higher time frame to lower time frame concepts, but you have to know the basics, and you have to know the bare basics to any of the concepts and apply them yourself the way it's being taught before you can go and start trying to make adjustments. And you shouldn't make too crazy of adjustments, because things are the way that they are for a reason. Because again, everything's ran by an algorithm. It's all systematic. There's no dark figure hiding in a crazy office somewhere trying to manually destruct things. Sometimes obviously manual intervention takes place during red folder events, because they can just push a button and things go sporadic and don't follow any logic. But there's logic and reason behind why things do things, and that's why this is 100% a field that you can be successful in and be confident in, even though it's majority probabilities. There's ways to build certainty, and I hope over the last couple of months, and as we pass through this year as well, those of you that hang around and spend time with us, you get to see the consistency and how this is possible with people outside of the source, ICT. Because again, some people find it difficult to learn from him, and it's unfortunate, but at the end of the day, it's undeniable. If you take him out of it and you go look at people that apply his stuff and have achieved full-time trading and achieved some type of profitability, even if it's not full-time, you'll see the commonality is they separate the man from the concepts. And you don't need every concept. A lot of people try to throw the kitchen sink at everything and try to learn all these different things and put them all together and make a Frankenstein approach. And it's just that never ever is effective for anybody. And it extends your learning curve because you're not focused on one thing. There's too many decisions to make if you have too many things you're trying to juggle at once. And that's part of the thing, or part of the goals here in this community, as it says in my bio, right? Taking things from confusion to clarity, because there's ways to simplify and organize things rather than having a ton of different approaches and mixing them together. Making it may feel like, I'm learning a lot, but at the end of the day, there's each concept that you try to put as a Frankenstein over another one without mastering the one you're trying to add on to. It just extends the complexity, and simplicity in the market is critical, because when you're in the market, especially if you trade on the seconds charts or the 1 minute like I do, if you have too many things pulling your attention, it's very, very difficult to try to come with assurance when you're trying to take an entry or make a decision. And it fogs everything up. Then you get analysis paralysis, and then the negativity flows into your mind, and you start taking losses, and then the doubt kicks in. It's a constant cycle, and but it's a cycle that you can overcome, and it's not necessary. It takes some time to be able to overcome it, but again, I hope that a lot of the stuff we talk about here can help most of you guys. I know it's helped a lot of you guys already break through that, but I hope we can continue to help others that are dealing with those types of things, because it's not a fun aspect of this industry to have to go through those things, especially if we got kids or things that are happening in our lives and we're just trying to get away and improve our situation. There's ways to make it a lot more sure. And again, I hope that you guys get that from the content we provide here. With that out the way, let's go to the weekly real quick, take off some of these drawings. So we can see how for the 30-year bond yields, again, this dictates where the DXY is going to go, influences where the DXY is going to go for the most part. We can see how we have dug lower. If you go back to one of the other videos that I did when price was up here, one of the live sessions I did on a Sunday, I said that if this bearish order block does not break through the midpoint, it's likely that we're going to reach down and take out these equal lows. Right? Remember that call? For those of you that were here, I was asking you guys a question. I was like, okay, what do you guys see in the chart? What stands out? And I pointed out the fact that, when you're looking at a naked chart, you want to identify the smooth edges. Where are the equal highs and lows? And we were able to identify this equal low here. And I said, if we stay below this gap and we stay below this bearish order block here, and it respects the midpoint, we would in fact try to reach down and probably target this, or at a minimum target the equal lows here. And then whatever happens there, we're going to have to see, because, it could easily respond here. I can tell you right now that if we break through this this fair value gap here, and it just starts closing like below the high here, and eventually breaks through this and gets down below it, that'll most likely turn into an inversion fair value gap, and that will potentially drag the DXY lower. Because again, the bond yields, okay, dictate and influence where the DXY is most likely going to go. All right, so if we, but again, if we can get a strong response to the buy side and we break above this candle here, this may turn into a bullish order block, right? For the most part right now, we're at a point where price is going to have to make a decision in order for us to be fully confident in one side or another for this asset. You could see that we've taken out buy side liquidity here. Okay, so it's ran out the highs. If we zoom out, we can get a little bit deeper picture. We see a fair value gap here that it's also purged into. Before it reached up in there, if you go back again to a lot of the live sessions we've had this in our crosshairs. We've had this high in our crosshairs way before it even got up here. You know, and now that it has blown that out, right? In one of the previous calls that we did, I think it was like 2 weeks ago. I was sick last week, so that's why I didn't put anything out. But if you go back to that other video from 2 weeks ago, you could see that we were talking about this. And then if you go back even further, you'll see that this has also been in the crosshairs, right? For those of you that are interested in trying to go validate what's being spoken about. All right. But again, so since we've taken out buy side, right, price is now retraced. It's very logical that they would have done this. This does not turn this market bearish overall just yet. We have to have 3 PD arrays getting totally violated. In this case, we have this gap here. We see a respect to this order block pushing price lower. And now we have this fair value gap. So if we're going to be bullish here, if we're going to see this market go higher and maybe attack these equal highs up here, and then maybe even try to attempt this at a future time, we're going to have to see this fair value gap hold in price. Okay, we also have this weekly bullish order block. Okay, so it's punched lower into a 2-week bullish order block on this 2-week chart. And then it's also filled in this fair value gap here on that normal weekly chart. Okay, so looking at this, the only way I would trust that we are longer term going to be bearish is if we break through that and use this as an inversion level. This is very easily being looked at as a retracement to possibly continue to go higher. Looking at price here, as it is in the chart right now, if price was to want to reach higher, right, if it was to give us a strong bounce and show evidence that it wants to go to the buy side here, we would then measure out this large wick here, and then these would be potential targets to the upside before this monthly high gets targeted. All right, does that make sense, you guys? You guys have any questions? Let me know in the chat. I want to make sure you guys are still in line with what we're talking about. Again, at any moment throughout the call, you guys, if you have any questions, just let me know in the chat, and we could circle back and talk about some of those questions. Yes, so I'm going to keep note of this wick midpoint just in case. It's amazing because I have the same markups, so my awareness is becoming much better. Hell yeah, Tony, it definitely is. 100%, and you are more than welcome, brother. I appreciate you and your support too, man. You know, because think about it like this: there's so many people on the internet that have large, massive followings that don't know what the hell they're doing, and people fall for the things that they say because they're out here showing a bunch of probably demo profits, you know, trying to shove massive, insane gains in people's face that are, you know, not even possible unless you had like a massive amount of money. You know, like if people are out here showing 10, 20, 30, 40, $50,000 profits, unless they have like multiple funded accounts or a giant personal account, you know, that's very unreasonable unless they're over trading and over leveraging. And if that's the type of crap they're doing, they're not worth listening to. You don't want to listen to a over trading, over leveraging, you know, attention junkie. You know, most of them don't have the slightest idea what the hell they're doing. And, you know, people want to see that. They want to be sold an image, even if the people are lying. And that's just not something we do here, you know. Because at the end of the day, you know, people can't spend my money. I did show some of the massive stuff that I did last week. I made like 30 grand last week. And it, you know, my private community saw me point everything out at the very beginning of every session. But I don't like putting things in people's face like that, because again, you can't spend my money, you know. So, you know, sometimes it's inspiring. Obviously, it was inspiring for me until I found out that most of these people are lying to my face. And they don't know what the hell they're doing. And that's why everything I learned from these other people ended in failure and extended. I could have been profitable much faster if I didn't focus on a lot of these idiots the first 6-7 months of my trading, you know. So some things to think about, you guys. But yeah, so the assumption here is obviously if we can get price to break out through this fair value gap here, and get above that, then obviously we can continue to possibly favor price looking to reach higher. We're just at a moment where price is going to have to make a decision, right? This is very logical. If we go from low to high for price to retrace, we got a fair value gap, bullish order block. So that just, you know, in my opinion, this is still not fully submitting to the idea that we're going to be overall bearish for longer term view. That would change, obviously, if we can get down below this fair value gap here and use it as an inversion. That solidifies my interest in DXY, possibly looking to target further sell-side delivery, right? But at this current moment, I'm going to just assume that this is not going to entirely favor dropping unless, obviously, next week changes things. CPI is obviously going to be very impactful. If you guys were here in the previous call that I did 2 weeks ago, I talked about how the economic calendar can generally be a timing tool for higher time frame moves to take place. Like if we're looking for this fair value gap to shoot price higher, right? A lot of times that is going to be initiated through some type of intervention through smart money or the large pockets. You know, they're going to come in and identify specific levels and use the news as a reason to have that elevated volatility away from a particular direction or to a particular direction, right? So you may be thinking like, okay, price gets down to here. Well, when is it going to respond higher or when is it going to respond lower, right? It doesn't matter what side you're looking to see. Well, you take that question and you go look at the economic calendar, and you can use the economic calendar as a macro tactic, similar to how we use the lower time frame macros and price on that lower time frame, 1 minute and seconds charts, 5 minute, whatever. It's very similar, you know. So you take the economic calendar every week and look at things that way, and do a rolling study on this, and you'll see it's very fascinating how controlled and systematic things are, and how you can plan your trading in such a way that it doesn't overtake your entire life. And, you know, it could be ran like a business, you know. So these are essentially the things that I'm looking at here. We also have a weekly low here that we can also keep in mind if price does want to give us some type of interest to go lower. But we'll have to see. And again, if it breaks through this fair value gap here, I'm looking for that to turn to an inversion. Chawezi. It's an awesome name, by the way. And you saw the trades I did this week on Instagram. Awesome, bro. Yeah, I don't do that all the time. Because again, you know, I'm very big on the fact that, you know, people that come to me need to focus on learning the tactics, not, oh, I need to get a signal because he's good. That won't make you money. Because think about the things that happen when you take signals from people. You know, you may get in, but if you don't understand, like, okay, how this person thinks, you know, if you don't understand how this person takes profits, what they're targeting, how they think, it's going to be difficult because you're going to have your own demons trying to make you hold it longer. You know, it'll convince you if you're in profit that, oh, well, I got in the trade because of this guy, and he may or may not have taken profit where he said, but I'm just going to hold it because I think it's probably going to go higher. And then all of a sudden it turns to a loss. Then you blame the person giving you the signals. And then that's a cycle that continuously happens, and it distracts you from actually learning. That's why I rarely show, if ever at all, show any like actual like, hey, this is how much I made, because it's some people get discouraged, some people get encouraged, but then again, you can't spend my money. And if you're just starting off and you're just trying to get your footing and be consistent, it's unrealistic to expect $5,000-$10,000 days. It's unrealistic to expect $1,000 days if you haven't even seen profitability at all in any capacity, even on a smaller account. So it becomes a distraction. It's very encouraging, and you want to use it as an encouragement and like something you want to aspire to, but you got to keep in mind that just because someone else is making a ton of money doesn't mean that if you follow every trade they take that it's going to happen for you, because as it always does, we're human beings, and we'll make the mistake of thinking outside of what is being told, right? Or what is being spoken, and we'll try to hold too long. Maybe our risk will be bigger, so we'll take a larger loss. Maybe this is something that happens all the time. The person giving the signals gives the signal, but doesn't say anything about how they're managing the trade. And then maybe an hour later, they'll say, oh yeah, I took profit at so-and-so level, and nobody else knew that the person took profit. That's something that I witnessed with Mamba FX, because I went in like maybe 6 or 7 months ago, and I wanted to see how he runs his signals. I wanted to observe and see, like, okay, this guy gets a lot of attention. Let's start looking at what these people do. Are they really profitable? And more often than not, this dude would say he sends signals similar to pretty much everybody in the industry. They send the signal, and then they portray as if, they got out at this level and everybody should have known it. But the majority of the people are commenting, I took a loss, I took a loss, I took a loss. So again, it highlights the fact that it's a distraction. If you get in and try to find a mentor, you want to make sure that, for one, they're able to call the market. Who cares if they're able to get in and get out? Are they able to call the direction? And we prove that, and have proved that for the last 3 years here using ICT concepts. All right, so that's number one. Okay, and then number two, you want to vet the things that they're doing. Are they actually, is their logic even making any sense? Or, and you also want to observe what your goals are. Why are you following somebody? Like, for example, why are y'all here watching me? For the most part, I'm grateful to say that majority of you guys that follow me on all my socials, you guys are here to learn, and the ones that are here for signals only, like, I need to follow everything he's doing just because that's all I want to do, they get removed quickly. Okay. And for the most part, I don't even allow those types of people into my community for the sake of the people in my community. They're all here to learn. They want to actually be successful, and signal junkies, for the most part, they're just a distraction for everybody, and they're not helping themselves, and they don't bring no value to a community, which is very much something that I focus on when I do bring people into my private community. Everybody needs to be an asset. I don't care if you're a new trader. If you're a new trader, but you're over here being honest about the things you're going through, and you're voicing the things that you're going through, and you're asking questions, and then people are giving you advice, and you're applying those, and you're giving your progress and things you're having difficulties with, that's an asset. It doesn't always have to be that you're profitable for you to be an asset. We all deal with these battles at first, throughout our journey, and it's an asset to someone that's one step behind you. If you're 10 steps ahead of the person that's just starting, you're an asset to that person, even if you're not profitable yet, even if you're still going through some stuff yourself, because those things can be an asset to someone else. But we're in an industry, unfortunately, that tries to shy away from those things, tries to hide those things. I'm the first one to say I'm not perfect. I take losses. I get it wrong sometimes, but that, again, over time, those things get dealt with, and there's ways to build systems around your mistakes and the things that you struggle with, to eventually become, or to be able to overcome those things eventually, and it's not always about signals. Okay. Because again, if you can name me one person out of all these people that take signals that have been able to quit their job, go full time, and do some insane stuff by just following someone's signals, please let me know. And I'll probably be waiting forever, because there's not one person that I've ever met, or one person that I've ever even saw on social media that has said, yeah, I took this guy's signals and that made me quit my job. That's a telling statement. So if that's the case, everyone that tries to just seek signals, like that's a reality. So if you're trying to just seek signals, I mean, you're following a dead end. So what's more important is the tactics, how things are done, how you can do it yourself, and how you can be independent. So whenever you're watching anybody, I've mentioned this before, so is ICT. If you're watching anybody, your goal should be to be able to do it on your own. And maybe you like the vibes, maybe you just like hanging around people that are good at what they do. Maybe the experience they have is valuable to you. Maybe you're trying to build relationships with people that are doing the thing that you love. That's totally something that should be respected. That's something that should be pursued, because trading can be very lonely. So if you can get around people that admire this industry like you do, that are maybe a couple steps ahead of you, or maybe have achieved certain things that you would like to achieve, that are willing to help you, it's worth the time investment, the monetary investment, whatever the case may be, in order for you to get around those types of people. Because a lot of the people that are actually really good at this, they're not big on social media. They don't even have a social media. Okay. I know some people from ICT's private community that don't even have social media, yet they're smashing everybody on the internet. There's some that have come out publicly, which is amazing. It's amazing to see, because it shuts down all the people that are trying to lie on this industry and disrespect the things that we do. But yeah, it's good to get around the right people. And again, you want to be able to see that these people know what the hell they're doing. And part of that has to do with them calling the market like we do here. And again, if you spend any time here, you see that there's ridiculous accuracy. it's ridiculous. But yeah. So yeah, we're gonna monitor what this does, but that's pretty much it. We'll just drop down to the daily chart real quick, just to get a feel for what we have here on this daily chart. All right, so we have this fair value gap here. It's gonna be interesting. Again, if we can. So going back to what I said about the weekly chart here, how I said this weekly fair value gap, if it doesn't hold and price breaks through it and gets below it, if you drop down right here to this daily chart, you can also see that if it was to respond and do that, we have now even further clarity and context as far as why that would be justified, as far as that potentially leading to us continuing to go lower. This would then show that there was runs on stops. There was a big shift in market structure here. Right? And then if it fails to break through this fair value gap and it gets below this weekly fair value gap, maybe it delivers down below these lows here off of this daily and weekly fair value gap combo, then obviously that could be leading us to, further sell side. And then again, this market dictates and influences where DXY goes. So we would then use that information and apply that to the DXY and then favor shorts. And as a result, obviously, we should, if everything's going to be symmetrical, see the indices go higher, right? If that was going to be the case. But again, we'll see. We'll see what price does when it opens up in this coming, later today, obviously. We'll see how that operates. Maybe it fills in the rest of this. Maybe it just doesn't do anything. Or maybe it'll gap lower and then possibly target the lows here, or gap lower just to get down below this. But yeah, these are the levels that we're going to be monitoring as far as tracking in terms of narrative and what it's going to do. But if we stay below this fair value gap here, I'm going to favor this going lower, right? So let's pull up the three indices real quick and do a trio analysis. I didn't do that the last couple of sessions. I want to definitely highlight the trio. I mentioned it a little bit early on. The importance and what you do when you're looking at all three of them and why you want to have all three, because sometimes it'll tell you when a quarterly shift is going to take place. And then, of course, you can merge that with seasonality. You can merge that with COT. And then, you can get a really clear picture when price is possibly going to make a turning point, maybe adjust the sentiment in the marketplace based on those factors. But yeah, if you guys get value from the content, definitely like the video. Subscribe if you haven't already. It's much appreciated. Again, there's so many people on the internet, and the fact you guys spend time with me here, it's greatly appreciated. And I hope all you guys get value and can make the progress you're looking to make this year. That's the goal, right? But yeah, so So yeah, obviously you could see that there's a lot of very similar aspects to this 30-year when you look at the 10-year and the 5-year. We still got this fair value gap here. We have a new week opening gap in here as well. If you look right here. So we'll see if it wants to stay below that as well. There's so many layered new week opening gaps. When you see that type of phenomenon taking place and prices just bouncing around like it was over here, and there's multiple new week opening gaps and many overlapping candles when you're looking at the higher time frames like this, like overlapping and everything's just like back and forth like that. Those are all things telling you that we're in low probability conditions, high resistance conditions. Very easy signals to identify, so then you could start to map out the situational awareness, the conditions that we're currently in the marketplace, So, it doesn't have to be overly complicated. Sometimes it will be a little hard, sometimes it'll seem a little foggy, but hey, understanding these little concepts like this allow you to start making sense of the chaos at times when things look a little blurry and whatnot. But yeah, so if we switch around a little bit, move over to this one. So the 10-year has a very similar aspect. I did mention an SMT here. Let me go back and double check that. So I'm talking about that, I'm assuming. Yeah, so I guess there is an SMT at the highs there, but we'll see. It's kind of suspect to see. Now that I'm looking at this 5-year, it's kind of suspect to see how we have retraced into an area where we could potentially see a bullish run in price. But then we also have possible relative equal highs up here. Seems like a layered level of liquidity up there. So again, we're just going to have to monitor and see what price is going to want to do here. If it stays above this weekly fair value gap, again, very easily we can identify that price is going to go higher potentially, especially if we break through the midpoint. If we eventually break through the midpoint of this, that solidifies and cements our ability to trust price is going to possibly seek more buy-side liquidity. But again, if we stay below this weekly fair value gap, if we stay below the daily fair value gap I just mentioned here on the 30-year and the 10-year, if we could stay below that and then we get below the weekly fair value gap, that will then solidify our trust in price going lower. I'm assuming that we're going to respect this going into the next week. We'll see. Obviously, if that changes, then we have different validation factors we just mentioned for price to want to, for us to adjust our assumption in price. I'm going to just assume that, because weekly bearish order block's been respected, we've been hammering price lower. We have possible reasons for price to want to reach lower the weekly fair value gap. And then, if we break through this and get below it, then we can obviously trust it. If not, and it breaks above and uses this as an inversion, we simply adjust. And then on our way to that weekly bearish order block I mentioned, to that midpoint, we also have other targets, that being the high here. We also have a fair value gap in here as well. Very similar across the board. So yeah, we have a weekly high here too. Weekly high was taken out if you look closely. The gray zones, again, for those that don't know, is separating our weeks, Sunday to Sunday. So this was the previous, one of the previous weeks, right? So we have a high here. We set relative equal highs. This is the previous week's high here, right? So you can mark that on your chart. I didn't mention this earlier, but I mentioned it in the previous call we did. Again, one of the first things you do, you go obviously to the weekly, monthly, and you identify the current weekly, monthly, and daily highs and lows. And then you keep those on your chart because those are going to be your most near-term liquidity pools. And then any PD arrays that are around those levels, and specifically on the weekly chart, any PD arrays that are around the previous week's high and low can generally be identified as our most near-term target. And then, of course, if you drop down to the daily time frame, you could start to get more liquidity points that you can pay attention to. And then, of course, throughout the week, as we march forward and see price deliver whatever it's going to deliver, we also have session highs and lows. We have, again, previous days highs and lows, and London's highs and lows, right? Those are very important. New week opening gaps, right? If those are logically in line with a particular assumption, those can also be targets. We have regular trading hours gaps that are targets potentially. We have new day opening gaps that generally can be used as targets, or launching pads for price to make a move, maybe during a red folder or something. But all those different liquidity levels that I just mentioned there, those are the things that give you certainty behind the fact that you can always frame out a setup. Okay, if you take that list of liquidity that I just mentioned, those are forever going to be in the marketplace. Those will never not be in the market. Now, depending on which one is, like which one makes the most sense to be targeted based on the narrative and bias assumption you come up with, obviously that is a subjective thing, right? Sometimes those levels that I just mentioned will also be utilized as counterparties to smart money moves that take place. Like if we're going to go higher and the London low is like below us, aka obviously it's a London low. If we're going to go higher, sometimes it'll punch down, take out London's low, then allow itself to expand higher if we're in bullish conditions, right? So sometimes those some of those levels get utilized as counterparty to particular moves, right? If we're bullish, it's going to look for some type of sell side. Using that list that I mentioned, right, you can frame out important sell side liquidity, right? And then of course you could also use it as targeting, right? If we're going to go higher, you can also use some of those levels as targets, right? So again, that's just another reason why those levels that I just mentioned are so important. I've mentioned them before, and you're going to see as we do live trading, you're going to see all these levels implemented. You're going to see what I just mentioned, how price sometimes uses them to be a target or to set up a move to a particular target. You'll see all that stuff real time. And my private community students have seen that for years at this point. I did it last year as well when I was live on YouTube until I took the ending portions of the months as a break from YouTube. But yeah, so hopefully that's going to be very helpful too. I know I've gotten a lot of good reviews about that. And obviously those of you that watch ICT live when he used to go live, that's also very, very helpful as well, right? In the same capacity, so yeah. So yeah, I hope all this makes sense in terms of what we're trying to identify with the yields. I'm assuming until proven otherwise that this should be able to hold us. If not, again, we've taken out sell side. We're in a potential area that could act as a launching pad if we are going to go higher. If price is going to go higher in any capacity for the next week or so, it's going to have to use this area as its reason to go higher. It's very logical. We're at a higher time frame, weekly bullish, a weekly bullish order block and a weekly fair value gap, right? So if this can't be used as a launching pad after we have dropped so much here, then obviously there's no reason for us to push buys, right? If it's not going to go higher, then there's no reason, right? But if it does use this as a reason to go higher, then obviously you could start to see that there's trust being built behind the idea, and this was possibly just a retracement on that weekly time frame, right? Because it's logical, right? From low to high. Now, again, unless this fails, we commit to that, right? We commit to the fact that there's a possibility for it to go higher. I'm assuming that it's probably not going to hold, but again, it's very easy for us to make that adjustment going into this new week with so many red folders. You want to have opinions, but don't demand too much, and again, like I mentioned earlier, you want to drop your risk a fair amount as well this coming week, just to let the fireworks take place. All right, so yeah, I think I covered everything I wanted to cover for this asset. So if you have questions, let me know in the chat. But now we're going to move on to the bonds. Again, the bonds dictate where the foreign currencies like GBP USD, Euro USD, and the indices are possibly going to go. All right, so if we take off some of these annotations, just taking a look real quick. So yeah, if you look at the fact that we have these relative equal lows here, Okay, we have a bullish order block here, and we're pushing into a fair value gap and an order block here on this 2-week time frame. So we got a bearish order block here with a fair value gap. You can see how this is reverse to what the yields are doing, right? It's reverse to that, right? If we go to the weekly time frame, right? This has the weekly potential retracement into a bullish order block and fair value gap I mentioned. So again, we're going to want to see how that's going to respond as well. You know, so if this fails and just starts to dump lower, then obviously this is going to also fail and then run higher, because these are reverse correlated. And again, the yields, this asset class here, dictates where the DXY is going to go, and it allows for you to trust where DXY is going to go. And then the bonds here, right, the T notes, these dictate where the foreign currencies like GBP USD, Euro USD, and the indices are going to go, right? So we'll see what takes place with the yields and the bonds here. But pretty much everything that I said in the yields, you just reverse it for this asset class because they're reverse correlated, right? So they'll act in a manner like against each other, right? So if we look at the weekly chart here, again, we have a fair value gap in here. It's reached for a pretty deep premium based on this dealing range here from this high to that low. So we've pretty much reached a premium. So if it, again, just like how if the yields are going to go higher, it's going to have to go higher from this level. If it fails, it's going to go lower, right? And then our assumption is that price is probably going to maybe look to target things like this and the rest of the fair value gap, so on and so forth. And then the same thing can be said for this, but in the reverse. If this is going to go lower here, it's going to have to go lower from this area because we're at a premium. We've already retraced. Prices hit a fair value gap, right? So we've hit a logical level for price to continue, similar to what it did here, right? It rallied up, then dropped. So if this is going to continue the downside movement and attack the sell side here, or attack the sell side down here, these are relative equal lows. And then this is also relative equal lows here with a fair value gap, right? So that's kind of interesting. So yeah, this may be impactful here. Let me remove some of the drawings there. This fair value gap definitely has my attention. And if it, obviously if, you know, pulls down here and then looks to rally off of this bullish order block, that's something we'll monitor as well. If that takes place, right, and it declines a little bit, but then it starts to smash higher, not showing any respect to these bearish levels I have up here, then obviously, again, that's going to lead to this also doing the reverse as well, and then this will end up dropping as a result of that that assumption. All right, so those are the things that we're monitoring. The why things should do whatever they're going to potentially do. You know, where I assume price should continue going. I'd like to see this fail. Okay, I'd like to see us hit this fair value gap and then stay below. But I can easily adjust because we have all this stuff going on this next month. I'm easily going to be able to adjust if it is going to use this as a bullish scenario because it makes sense, right? But it also, again, makes sense that it could want to fail and go lower. So because there's two assumptions that can work at the same time and make sense at the same time, that's another one of those factors that allows for low probability, or not low probability, but to lower your expectation, because we don't have a solidified, like, this is for sure, in my opinion, going to take place. There's factors that could change whether price is going to go higher or lower in this scenario, right? For this asset and for the T-bonds, right? The T-notes, right? And again, if we can get a strong response to the downside off of this, then that's going to be very telling, right? And this would just kick us back into, okay, we're pretty much just retraced to then try to target sell side, right? Run price to a premium from this high to that low, just to take off and go lower. So we'll see what takes place. Again, if this was to use this order block here, or if it was to stay above this weekly fair value gap, then that's going to be pretty impactful, right? Because then we're starting to see weekly bearish PD array turn into an inversion and push price higher, right? So again, that's something we're going to monitor. If we look at the 10-year now, Okay, and a little bit closer, we can obviously see a very similar factor because everything is correlated, like, or not everything, but these three assets, the trio for the bonds, T-note futures, and the bond yields, right? The trios are fairly correlated. And we don't really see much of a crack in correlation. Aside from this low being violated, well, not violated, essentially, and then this one actually violated it. Right, so there is a slight SMT there. That slight SMT led to pushing price up, right? Giving us this retracement, allowing for us to make sense of why it had a turning point there. There was also a fair value gap in here that it used, right? It didn't even close outside of that. But now we have a very large wick off the high, right? So again, we're going to see what takes place with this. But my assumption, I would, again, if I'm going to want to see the yields fail and go lower, right, I would, not be surprised if we start to see reasons for this to want to push higher a bit. Looking at this, though, it's a little bit more convincing that we're probably going to continue. What solidifies that before that order block gets violated on that weekly chart, this one here, before that even was to be violated, right, if price does want to decline, if it breaks through this low here, this is a possible YouTube model setup for this time frame, right? Because now we got run on stops, we're in a premium, it's in a downtrend, right? And then if we shift market structure here with some type of large impulsive move, I mean, that's pretty telling that we'll potentially look to seek the fair value gap here. We have trend line liquidity, right? So, maybe that's engineered if it was to look to favor and start to turn this fair value gap into an inversion, or turn these consecutive up candles into a bearish order block. If we go to the 2-day, you can see that's a very, very clear potential order block if that low was to be violated, which would change the state of delivery. Okay, at a time where there was a retracement back to a premium inside of a downtrend overall in the higher weekly time frame. Right? So all these things are in my mind when I'm doing analysis, and hopefully eventually, a lot of these things will also be in your mind and make sense as well. Do you guys have any questions so far until we get to the, before we get to the DXY and into the indices using this information that we've been able to pull away from the interest rate markets? Let me know if you guys have any questions before we move on. Try to make this call less than the other one was, 2 hours. Try to make this like an hour and 30 minutes. Depends on obviously what we talk about. But yeah, just let me know in the chat real quick if everything makes sense, because I don't want to just like fire hose everybody and some of y'all fall behind and not get the value I want you guys to get. Just give me like a 1 in the chat or something like that. All right, well, again, if you guys have any questions, just toss them into the chat. But for now, we're going to move forward. So, yeah, with all that stuff we've talked about so far, right, we'll take that into observing the DXY. And it's pretty obvious at this point, based on me saying that the yields dictate, that being the yields here, okay, this generally dictates and influences what the DXY is going to do, or what it could do, okay, because sometimes it has a lagged effect as well. But yeah, you could see how there was a run higher and now a retracement into a weekly level, a weekly fair value gap, weekly bullish order block for the yields. Now again, if you scrub over here, doesn't that look extremely similar? Right, so this just shows evidence that the yields and bonds are so impactful. and how they can give you foresight. They can build trust behind your assumption rather than you just going to the DXY and the indices first. This is why we start where we start. This is why we look at the bonds and yields first. We look at the economic calendar first. It's a systematic process that allows us to have a more educated assumption as far as what the DXY and the indices are going to do. It builds trust and it builds more confidence in your ability to identify particular levels. And this is, this process is how I'm able to call the market's direction more often than not. I've had a lot of questions like how do you know, like all these things. There's these specific tactics that allow you to build trust, and like Tony asked earlier, once he masters patience, it'll change things, right? Well, mastering patience is afforded to you, and trust is afforded to you by these types of analysis tactics, because everything's interconnected. Everything has a place, and some stuff will impact certain assets dramatically, and some assets will dictate where they're going to go potentially, and what side of the market could be trusted or not. Some assets like the bonds and yields dictate for the most part why we're going to be in a trending market for the DXY and the indices, or why we're in a consolidation and not really doing much, right? The bonds and yields aren't doing anything at all and they're stuck in a range, like I've mentioned before. It's going to indicate or influence the other assets like the DXY and the indices to not be allowed to trend, right? Same with the currencies, right? If we got the bond, the T bonds and the yields consolidating, that's going to really impact currencies and, like I said, indices and the DXY. But if they're really quickly moving and very much trending, the interest rates that is, that's going to impact and allow for fast one-sided moves in the DXY and the indices and the foreign currencies like GBP USD and Euro USD. All right, so again, there's a reason why we start where we start, and then eventually end up where we end up. There's a lot of people that are new to ICT concepts and hop on, obviously, and they see me talking about the bonds and yields, and instantly they're turned off, not realizing or paying attention to why it's so important. They want to be consistent. They want to have trust. They want to limit the amount of times where they feel like they're doubting themselves and all this stuff. Yet a lot of people are unwilling to listen to the very things that allow for that to change. So it's unfortunate, but hey, it is what it is. It is what it is. Right, so taking what we talked about with the yields, how it has a chance to possibly go higher if we do respond from this weekly bullish fair value gap and order block. Taking that to the DXY, you can see that we're in a very similar capacity here. Right, we've got a very similar thing going on. Okay, just remove some of these. Just keep it clean. So if we go to the monthly chart, let's just label out some critical levels here. Monthly high, previous monthly low. I'll just keep the weekly low there. It's pretty much the monthly low and the weekly low. They essentially line up, which is sometimes the case. So if we extend that out, right? So this is our current range that we're in. We've also delivered off of the monthly fair value gap, right? It pushed off the high here, but then it also, in conjunction, filled out the rest of the weekly fair value gap. Okay. And we've had this, if you go back to some of the videos, we've had this outlined. I outlined the entire run from this above the highs. I outlined this run before I got up above these highs. If you go back and look at the videos, right? We're in line most of the time, and the process that I show on a weekly basis that may seem boring to some is the exact reason why. And, a lot of times it's the barrier between them being able to call the market consistently or not. You know, we want to be able to trust things, right? And the whole goal of this page and channel is to take you from confusion to clarity. You know, and a lot of that's influenced by the processes you employ, whether you even have a process you use that's repeatable. Think about it like this. If you don't have a repeatable process or system that you can do on a continuous basis, you don't have a continuous model, or, you know, maybe there's a couple models you use, but if you're not able to master all of them and use them consecutively and get the data, how are you supposed to gain consistent results? How are you supposed to track your progress if you're doing 500 things at once? You know, like you have, if you want consistent results, generally you got to do a consistent thing. Like when you're working out, you got to go consistently, do consistent workouts consistently. You know, you can't build your biceps if you're trying to work on your legs every day. You know, and that's, you know, it's very similar to, you know, if you're trying to master one model in the marketplace and you want to get consistent gains in terms of profitability and growth in your account, you can't do that if you're not identifying a consistent process, you know, and doing very similar things. And you can't improve on things you're not tracking, and you can't track something that is scattered all over the place. You see what I mean? So that's why so many people struggle with this industry, specifically with ICT concepts, because, you know, again, they come with a kitchen sink and they're trying to mix everything together, and it's like, how are you going to be able to gain any consistency with a bunch of random things being used? You know, like it's one of those hidden things below the surface that majority of people don't realize. Like, I want to be consistent, but I don't want to have consistent results in my study. I don't want to do the same thing over and over and get good at that one thing, or I don't want to study each concept individually so that I can be a master at those and then eventually learn to put them together in a repeatable process. They want to do all these shiny objects, you know, like, oh, there's a breaker here, there's a YouTube model here, there's an optimal trade entry. Oh, maybe I'm going to try the stochastic. You know, maybe I'm going to use one contract, but then again, let me just use 4 contracts. Or they're trying to use the order block. Oh, but I see a fair value gap possibly there, so maybe I'm going to use a breaker, or maybe I'm going to use, you see what I mean? Like, just mixing everything at once. How are you going to go back and journal whether any of those were consistent or not, or whether you're able to identify your strengths in any of those things if they're all being used at once? If you want to have multiple models, I have 4 models. I use a YouTube model. I use breakers. That was the first thing I used. The breaker and the market maker buy and sell models were the first 2 I used. Then obviously ICT came out with the YouTube model, easily was able to implement that. And then I have the institutional order flow entry drill that I've been able to use also for the last 3.5 years, right? And that's just a continuation model. And one thing people don't realize too is there's continuation models for a breaker. There's continuation models for optimal trade entry. There's continuation models for the YouTube model. There's continuation models or variations for pretty much everything, you know. And that's one of those things that most people don't know. You know, that's why ICT's statement saying that you can use one model and be successful and find as many opportunities as you'll ever need. That's why he says that, and that's why it's valid for him to say that. Because every single model we operate within or choose to use has a continuation model or variation within it. You know, breakers don't just show up one time in a price leg. Optimal trade entry doesn't show up just one time in the price leg, right? Any of the other models don't just show up one time in a price leg. You know, there's multiple different time frames. You know, you frame things from the higher time frame, but as you drop down, the world opens up. You know, you may find a 15-minute bearish breaker, but then you go down to the 1 minute and there's another bearish breaker there as well. Or maybe there's 2 or 3. Or maybe if price is retracing into the 15-minute breaker area, maybe on the 15-second, there's a bullish breaker for you to take, targeting that breaker, right? That you're possibly going to sell off of. You know, so, you know, mix in a little counter trend thinking there as well. You know, so you could see that, you know, one model is very useful. It's very deep. You know, all of them, every single model that's taught in ICT concepts can be broken down into fractions, right? Like you could like split it up into different time frames, and find such a vast world of opportunities, even if you employ one way of doing it. I hope that kicks a light on and starts making you guys question and think like, okay, well, how is that possible? How can I observe that? And again, those are some of the things that will be talked about in our live calls. And again, if you guys follow me on Instagram and stuff, you could DM me and maybe give me some specific questions so that I can cater some videos around what you guys have questions about as well. I do a lot of that with my private community. If they send me questions, I try to figure out if I can make a video or if it's worth me making a video to customize a lot of the questions and confusions into systematic videos, right? But yeah, keep that stuff in mind. That's why one model is useful. You can use one model. You don't need 500. And if you have 500 and you haven't focused on one at a time over years, you won't be a master at any of them. You'll just be very mediocre at all of them. And mediocre doesn't most of the time get paid in this industry. You lack preparedness if you don't have one weapon at first that you're able to build off of. It doesn't matter which one it is. It really doesn't matter at all, because almost every model happens every day. You can find all the different models happening every single day for the most part. Some are a little subjective, but at the same time, oh snap! What just took place? Can y'all hear me? Sorry, my screen just glitched. Whoops. Let me know real quick if y'all could hear me on the video. My bad. Something just like freaked out on my screen. Let me know in the chat real quick. Throw a 1 if you could hear me. I just want to make sure. That was weird. So weird. Yeah, all right, perfect. Yeah, my screen just like glitched out real quick. That was so weird. But yeah, so just keep that stuff in mind. If you learn one model, if you're trading ICT concepts, that one model can open up so more opportunities than you ever thought possible. It's not just one optimal trade entry happens or one YouTube model happens a day. They happen over and over and over constantly, all the time. It just obviously depends on what time frame you use and, what your approach is. What are your rules? Just because there are 500 trades in a day, possibly, doesn't mean you're going to take all of them. They have to align with your rules, and then that kind of shrinks the amount of opportunities you have. But we want quality over quantity, because taking more trades never should be looked at as I'm going to make more money. Taking more trades actually leads you to more risk. More risk if you get punished because you maybe make a wrong decision over and over and over, compounds the loss. When maybe you started the day thinking, okay, I'm gonna risk 0.5% or 1%, because you overtraded and tried to take too many trades, that 1% turns into 15% loss, or a blown account, or a loss funded account, or whatever the case may be. So if you trade 1%, for example, just another tip, if you trade 1%, but you're trying to take 2 trades in a day, you split each trade in half. So you have 0.5% for one, 0.5% for the other. It just splits the risk down. And if you do take full, say you're trading 1%, and you do want to take a trade with 1% risk on it entirely, you're going to have to drop your risk by half if you're going to take another trade. But that's the thing. You never want to look at, okay, this is my max risk at 1% or however much percent you have. You never want to put all that on one trade, because what if you're wrong, and then you take that loss, and now you're at a full 1% loss. That was your maximum. You want to be able to stretch your maximum risk, especially if you're trading funded accounts, right? Because if you only have like 3K stacked up in your risk like allocation, right? Say you got a 100K account, and maybe they're only allowing you to make or to lose 3%. You want to cut that in half and then trade like half of what you have available. You can't trade 5, 10, 15 contracts if you only have $3,000 you could lose, because just think about it. It's over trading. Reality, funded accounts, we only have a certain amount of risk allocated to us. We're allowed to trade 15 contracts, 5, 10 contracts. But if you do that and you maximize the amount of contracts you could take in that one trade is going to blow your account. So what do you really have? Do you really have a 100K account when you're doing that? From what I see, no, right? You only technically have 3K. You have the ability to trade more, which, that's the benefit from being able to have a funded account, because you're allowed to trade more versus having like a $5,000 personal account where you can't even put that much risk on, but it kind of balances out. It's kind of very similar, in terms of what you should be, what you should do, and you got to remember that, if you get a funded account and you were over trading and over leveraging to get there because you wanted to do it quicker and speed through the process, if you carry that mindset into your funded trading, you're going to blow your account. You're not going to it won't survive, because you'll spin around on tilt, right after you take the loss, and then now it's real because you can make money on it. So now the game changes, your psychology adjusts, and that's another journey in itself to get used to that. Not only is the technicals a process, but also managing accounts is a process. Upping your size is a process, because when you can see $1,500, $2,000, $5,000 on one trade on your screen flashing, emotions start to change. Your rules that you had that got you to having the funded account, for example, will generally be disregarded. That's why 90% of people fail in trading, but 95% of people lose in funded trading, because they go in there with this gambler mentality and they try to push it so hard, not realizing what the reality is. If you only have 3K that you can lose, technically you only have $3,000 leverage to use. Because if you put 5 contracts and you lose that 5 contracts, it's a big amount. Probably like half your allocated risk is gone, So just some things to consider. It's something that a lot of people don't think about. It's not sexy to talk about, right? It's not inspiring to talk about it like this. But mind you, this is war. This isn't, get rich quick life, okay? This is war, battle, okay? Like, I'm in the market to take someone's head off, to feed my family, to feed me, to grow my accounts, to make me successful. And you should be in there thinking the same way. And because that's the nature of the industry, and because the algorithms that run the market are structured in a way to punish, not reward you, you got to think about things in this way. The only person that is responsible for your money, who can protect your money the best, is you. And again, it's just not the things that people want to listen to or hear. It doesn't sell courses. It doesn't sell signal services. It doesn't do any of that. It doesn't make people want to, sit there and feel all fuzzy inside, but it's the reality. And if you're not going to tell yourself the reality, you got to hear it from someone else. And some people don't like to hear that, and then they'll just go and continue to fumble and, tumble and blow their accounts and waste their money, versus doing things properly and submitting to the idea that there's a reality in this industry that must be accounted for. Because, that's what's going to get you when you do get to the chance of profitability and funded trading and those levels where you do have enough size to make an impact on your financial life. You don't want to have these horrible rules. These horrible flaws still plaguing you. Because if you're going full time and you're still over trading and you have to pay rent, or you got to take care of your kids, or you got to, pay certain bills, imagine the stress that increases to. Just imagine. Right? Like, it's a process. That's why it's such a process to get to full-time trading. And you got to make sure you have a lot on the back end solidified, so then you can 100% depend on it and not have to take a trade tomorrow, or not have to worry about taking a loss, and you got to be able to have the trust based on years of experience and having your organized plan. So then you can know with certainty that, okay, my model didn't work today, but I know for a fact it's going to work tomorrow because I'm disciplined. I'm not going to blow my account. And I've proven it to myself over years. And I have an organized plan and process that has proven itself over the last, however many years. You got to be able to have these things on your resume when you're looking to trade full time, and trading full time isn't going to be for everybody. It's, it takes a lot. It's not what everybody claims it is. You know, it's not as I should say it's not as easy as people try to portray it as. You know, it takes a lot of planning. It takes a lot of being real with yourself and the circumstances. You know, you're not going to quit. You're not going to quit and go full time off of a 10K account. It's just not going to happen. You know, because if you think about it, unless you're over leveraging, which is going to make you get totally obliterated in one way or another in the near future, you know, you got to think like, okay, if I'm making, you know, 2,000 or 3,000 a month, and that's what I can live off of, for example, or maybe I want to make 5K a month. How big does my account have to be for that 3 to 5K? For that 3 to 5K to be 1%, so I'm not over leveraging, and I can relax and, you know, chill out. You know, think about it. How much money would that take you? If we're thinking about it from a professional-minded viewpoint, how it should be done, and not being like these idiots on social media showing all this fake profit that they're not even making because they're just selling something. You know, just think about it. How much would that be? Right? Generally, it's going to be anywhere from $50K to $100,000 cash in the account. You know, it's possible to do it with 25K. But again, if you're going to do it with less, you got to be able to have consistency on your side. If you're going to do it at any level, consistency has to be on your side. Not over trading has to be on your side, because that's just going to set you back and make it so you can't pay your bills. Not over leveraging, because over leveraging is just negative to your mindset. And the more you over leverage, the more you're building up that beaten dog syndrome. You know how when someone like has a dog that's abused, and like you'll flinch at the dog and the dog will just like panic and like cower away every time you raise your hand even? It's the same thing in trading. If you over leverage, over trade, break your rules, break your promises that you've made to yourself that you're going to follow a specific set of rules, if you continuously do that, you're putting a knife in you every time. And that cut gets bigger and bigger and bigger and bigger and bigger. And the scar tissue you develop over time, it's going to impact every time you take that trade, that next trade. Every time you go to push the button, the pain from what you've had to what you've put yourself through willingly is going to always rise to the surface. Every time you go to push that button, the more we do that. So that's why it's so important, and that's why I lead by example when I'm here on this channel and when I'm in my private community. And I that's why I lead with those things at the forefront. That's why I talk about them all the time. Because whether people want to hear it or not, it needs to be said. Especially if someone's looking to get good advice and do this full time, do this to replace at least part of their income, or do this maybe to just pay off a couple bills or debt here and there. You know, regardless of what level you're trying to reach or what you're trying to use trading for, that reality is going to be there. You know, you have to have structured processes. You're going to have to be able to have plans and processes in place and knowledge in place to allow yourself to not make these bad decisions, these bad mistakes like over trading, over leveraging. ICT has said before that it could take a year for you to make 50% gains, you know, maybe less, you know, maybe more, who knows? But it could take one day of over trading, trying to get that. I just wanted to make $200. I was at 180, but I wasn't satisfied. I just wanted to make 200. It takes one of those moments, one slip in mentality to lose all you made in the past couple months, past year, or even all the way down to blowing your account. And it doesn't have to be that way. That one trade you're trying to make today, that $200 you're trying to top off for today, it's not worth putting yourself at risk of being human and making a bad decision to overtrade and break your rules. Because once you take another loss, now it's at 160, right? Then you're going to think even worse, like, oh man, I shouldn't have did that. Let me try to make that back and get back to 180. And then you take another loss. Now you're down to $50. And you're like, oh my God, I need to make it all back. So then you over leverage. And then you're down thousands, hundreds. It's a cycle. And again, that behavior is so detrimental and extends your success curve so far into the future, because now you got to fix the problems that you just willingly gave yourself, on top of trying to learn and be systematic and get all the experience you need to do things properly technically. You know? So again, these are things that most people don't like to hear. But again, I don't have this channel to tell people what they want to hear. You know? I've been through a ton of shit, okay, in the last, 5-6 years. It's been rough, okay? The first 2 years was absolutely excruciating. Like it was brutal. Well, a year and a half. It was absolutely brutal. But I needed to deal with that because I'm the type of person that, for whatever reason, has to learn through experience. And I don't, like to listen a lot for the most part, unless, it's reasonable, obviously. But I like to experience things on my own. And I'm stubborn, hard-headed at times. And unfortunately, that character flaw dragged itself, showed its ugly head in my trading early on. And I had to seriously make plans and processes that protect me from myself. And it's going to be the same for you guys. And again, that's another thing that people don't like to admit. But that just puts a false picture in people's head. And when people fail, they make excuses if they don't admit to their faults and their mistakes, as they should. You can't improve upon something that's not acknowledged. And you can't track, again, you can't track something that's not, or you can't improve upon something that's not being tracked. So you got to keep these things in mind. Trading is bigger than just figuring out where these candles are going to go. It's a mirror, and it could be the best thing that ever happened to you, or it can be the most excruciating, torturous experience you've ever had in your life. But it's up to you to figure out which direction you want to take it. And it's just decisions. It's discipline that dictates whichever direction you're trying to go. If you want to break your rules and be undisciplined and do whatever the hell you want and try to force your will on a market that's literally made to destroy everybody and keep the rich people rich and offer things to them, or are you going to turn it into something prosperous for you, so then you can ride their coattails and make this something somewhat of an asset to you, whether you're trying to replace a job, whether you're trying to put it alongside your job just to have an extra income, or if you're just trying to pay off certain bills, or maybe you have a goal that you're trying to use trading to assist you in. Whatever it is, you're always going to have to be disciplined. Your first priority is to manage risk. Okay, you need to have an organized process. Okay, you have to figure out why you're taking a trade, and an indicator is not 100% going to be helpful to you in that regard, because there's logic you can follow. It's going to be possibly helpful somewhat, depending on how you use it in terms of indicators. But price is giving you all the information you need, so, and again, just to reiterate, you want to acknowledge where you have your hardships. I appreciate Tony in the chat, because he always voices his struggles. All my private community students that are with me, they always voice where they struggle at, and they have no hesitation to do so. And they've become better because of it. And I couldn't be more proud of them. So just keep these things in mind, you guys. It's these types of conversations, these types of things that we focus on and look to improve. These are the things that are going to get us to where we try to aim for, and there's no getting around it. You can only push it off for so long. These reality-based, factual things that everybody has to break through as a trader. There's no way around it. You have to go through these things, and you have to eventually admit certain stuff that's very uncomfortable. None of us want to admit that we are imperfect. None of us want to admit that we have character flaws that stop us from being disciplined or making certain decisions that we should make. Nobody likes to admit those things. But the market, you're either going to admit it to yourself and work on it, or the market's going to shove it in your face and force you to bend the knee by blowing your account over and over and over and over and over again. You got to pick one, because you can't have both. So that's just the reality. You know what I mean? But yeah, hope that was valuable to you guys. It's very important. I'm grateful that I had ICT to shove this mindset into my mind early on. It's just one of those priceless things you can't put a dollar amount on, that really, really allowed me to thrive and do what I've been able to do and accomplish what I've been able to accomplish as a trader over the last 5-6 years. So So I hope it helps you guys just as much. And again, if you guys ever have any questions about these types of things, psychology, or maybe you're struggling with something, I'm always here to listen and help, because I know how hard this stuff is. And I know how difficult it could be, especially if you have no one to turn to, no one in your family that understands, nobody that you can contact. It's like ICT is great, his private community and all that stuff is wonderful, but he's not available the way that's some people like me would have hoped and wished for. You know what I mean? But it's not any fault of his own, but it's just one of those things, and that's part of the reason why I do what I do here on the YouTube channel, and offer my time and have my private community in a place where I bring specific students, the ones that I feel can be an asset to the community, that want to be an asset themselves, that can bring value, that are honest, that actually want to see this as a business rather than a weekend fling or like a one-hit wonder type of thing. It's Tony. Oh, that's your backup account? Tony, you got 2 accounts? That's interesting. Yeah, Tony, you're right. It could be life-changing. It just depends on how you look to apply things and what you choose to do with it. Whether you want to admit it or not. Because again, you have one of 2 options. You're either going to admit it and make adjustments and force change on yourself, or the market's going to do it for you. And the market has no mercy. I mean, you could just see, you put multiple entries in the market and tell me if it's going to stop the pain. If you're down, if your whole account is blown, you think it won't blow your account more? It'll drag you to hell, like if you let it. And it's a process to recuperate after you take, or after you put yourself through some stuff, some of the hardships. It's a process to get your confidence back. And that's why it's just best to be on the safe side. Don't be fearful. There's nothing to be fearful of, especially if you follow your rules. If you have rules in place, there's nothing. What are you scared of? If you have rules and you execute on your rules and it doesn't work out, okay, cool. It repeats over and over and over again. Everything. The process is continuous, as you guys that have been here for a while have seen. It's every single week we do the same situation. The only thing that changes is where price is at and what it's reaching for. That's it. Everything else stays the same. So on my way to work. Perfect. I appreciate you staying locked in even when you're on your way to work, brother. Truly appreciate your support and interest in the stuff that we talk about here. But yeah, so I just wanted to put some of that stuff in here aside from the technicals. But yeah, like I was mentioning about the bonds and yields, right? It looks like the yields may use this as a reason to go higher. We'll see what takes place. We'll be able to trust buys even further if we start to really ramp through the gaps here that I have mentioned, the new week opening gaps. And just if we smash through this weekly bearish order block and then we break up to the midpoint here of this weekly bearish order block from this weekly fair value gap, then again, that's going to be very telling, and we'll be able to trust that the buy side will be attacked. This is a weekly time frame, so if you let's use this one. This is a weekly time frame, so obviously the high of this candle and the low of this candle are important. That's a weekly high and low from the previous week. So if price is going to go higher and target up here, it's going to have to get through that weekly high first. If it's going to target sell side and break down below this weekly fair value gap, it's going to have to break this previous week's low first. So that's why the weekly highs and lows are so important. That's why previous month's highs and lows are so important, especially if we're close to those areas. And that's why previous days' highs and lows are so important. They are reliable, consistent, always present liquidity pools that you can be 100% sure the price will target depending on which direction it's going to go. Right? If you're looking at the weekly chart to reach for a particular point of interest, then you got to keep in mind previous days' highs and lows. If it's going to reach for a bearish weekly area, point of interest, whatever you want to call it, previous day's lows are going to be in the crosshairs as it moves lower. And then also, aside from previous days highs and lows, we also again have the weekly highs and lows and the previous month's highs and lows. I say that again because it's so important. People always ask what liquidity, what high and low are important. Well, there you go. Those are the key levels of liquidity that are constantly in the market. It's very easy to get lost in the ocean of highs and lows that we see in the charts every day. But if you narrow it down, figure out what you think the weekly chart's going to do, and then you take those levels that you identify in the weekly chart and then break things down to the daily, and then just operate within previous days highs and lows, previous session highs and lows, London's highs and lows, so on and so forth. You could then start to really see some reliable opportunities, and then the more you study those particular areas on a daily basis, you'll start to see how, like I mentioned earlier, they can be used as setup points or opposing liquidity to, like, if we're going to go higher and London low is below us, maybe price is going to take out London's low, then go higher, and then maybe in that process attack a previous day's high or a previous week's high. Does that make sense? I hope that made sense. And then obviously it can be the other way as well. Maybe it goes higher, takes London's high to then start a decline, which then ends up targeting either a previous week's low or a previous day's low. That type of scenario, it happens all the time. Like literally all the time. It's like a situation that you can observe. It's power of three has to do with it, obviously. The open, high, low, and close, navigating the daily ranges. That portion of things has something to do with it as well. But yeah, so those key liquidity levels are so important, right? So assuming that the weekly fair value gap, if it holds and goes higher, obviously that's going to indicate to us that this weekly bullish order block here may continue to push price higher in the DXY. But again, if that weekly fair value gap fails in the yields and we get down below it and target weekly low here, then obviously we may end up targeting this area. Again, this is a weekly time frame, so that's another previous week's low. So the low on that candle is a significant liquidity pool, right? So that's a possible target. And then obviously if that's targeted and we stay below the weekly fair value gap, then we have the fair value gap that's also attached to this previous week's low here as well. Okay, so we'll see what happens. In order for us to go higher, it needs to stay above this weekly fair value gap. And then that's the same thing for this as well. Okay, we're inside of a weekly fair value gap here, a weekly bearish fair value gap. We've pretty much traded all through it. So we're going to want to see what price does, how it's going to want to push outside of that. If it pushes below it, then that indicates that we're probably going to be weak. And in conjunction with that, we're going to have to see the yields also decline as well, because that builds trust, that builds clarity, because the yields dictate where the DXY goes. It influences it. It's the blood for the market in terms of the DXY, and it's like the heaviest influence, because currencies, paper currencies, fiat currencies, chase a country's yield markets, right? Or just the interest rate. Interest rates push currencies in particular directions. The whole, like, it could get real complex behind the information as far as why that is, right? But we don't need to worry about why it is and all the technicals behind it, because again, the finance world can get real confusing. We just have to know what the influence is. What's the impact? If the yields and the bonds do something, what markets does it impact, and what's the relationship? Because that could then give us foresight. Like, say if the DXY is consolidating, but the yields are rallying aggressively, then that's showing that consolidation in the DXY is probably going to go higher versus it going lower, because the impact that the yields have on the DXY. And it's the same for the T-bonds. That has a direct impact on foreign currencies, what they choose to do, and then also the indices. Right? I say this all the time and repeat it over and over because it's that important. And students like Tony have seen this. You know, he the other day he said from the last couple calls of him applying this and studying this, he said it's mind blowing. You know, he's seen it how consecutive it is, and it's so faithful and reliable that it's one of the best things you could ever do is understand that relationship. Okay, so again, if that's going to be the case, right? If we're going to see the yields give a strong response to the buy side, then again, that will allow us to favor this to go lower. Because this is in a range at this point, like we have multiple overlapping weekly candles, we're stuck in a range right now. You know, it's just trading back and forth inside this large weekly fair value gap, and it's just, you know, overlapping candles. That is low probability conditions when you see the weekly or the daily time frame giving multiple overlapping candle behavior. You know, that's just one of those things, along with, you know, if price is hanging around equilibrium inside of a given range. If we take this swing low to this swing high, you can see equilibrium is right here too. So it's not unreasonable for price to be doing what it's doing here, on top of the fact that seasonally, January is a shitty month. You know, so all these things layered together build a picture as far, and they build the why as far as why the DXY is not really doing much, why it's not committing as much as we would like it to commit to a particular direction. So what does that mean? It goes back to what I was saying earlier, situational awareness, right? If we see these things in the marketplace, what does that tell us to do? It means drop your risk, don't push things, never overtrade. You should never do that anyway. Never over leverage. You should never do that anyway. But having a feel for the overall conditions based on like certain things like this and intermarket relationships and bonds and yields and stuff like that, you start to gain clarity. You start to build trust. More trust than if you would have just jumped to the DXY and the indices and just tried to come up with a determination as far as what it's going to do just based on that. You can do that, but you know, we want to be sure of ourselves as much as we possibly can. We want to have as much confidence in our decision making as possible, even though it's based on probabilities regardless. If we can add probabilities in our favor, right? If there's ways to do that, then I'd assume that everybody would like to have that on their side. And again, that's why we talk about this over and over. And, you know, students see it. You spend enough time here and you watch this stuff and do your own studies about it and take what I say, not at face value, but you take what I say and you go study it in your own charts, apply it as the weeks pass. You start to see things are systematic and there's ways to make this very consistent and trustworthy. All right. So again, we'll watch and see what the yields are going to do. We'll watch and see what the bonds are going to do. I'm assuming that, you know, again, if we run outside of this fair value gap, we'll go higher. If it busts down below it, it's going to turn to an inversion. At this current moment, it looks bullish, right? But again, if that fails, then obviously we change our assumption. All right. I'm going to stick to that. Again, we do have an argument for it not doing that and just respecting the fair value gap here and going lower. But again, the weekly chart shows that we may want to favor going higher. So we'll see. We keep this in mind, this fair value gap here, just in case it busts lower and gets below this fair value gap along with this weekly fair value gap, because that will then change our assumption and allow for us to trust the downside move, which would then correlate to this also failing and going lower as well. And then if all that takes place, we would anticipate bullishness in the indices, right? But if this follows the yields and the yields end up going higher, right, and just get above this fair value gap, turn it into an inversion, get above this weekly fair value gap and push price higher, then that'll indicate to us that we can confidently still favor buy side liquidity and continue to target more of the upper portion of this fair value gap on this weekly chart. We still have a little bit left over, so I wouldn't be surprised if they try to pull it up there and finish it off. But we'll see. All right, so we have the, is that a monthly high? Yeah, so we got a monthly high there. Previous week's high is also in line with the monthly high. And we got two weekly lows. All right, so these two weekly lows. I'm assuming that we'll probably see these stay intact if price does end up going higher. we'll see. Right, we're inside this bullish order block, and again, flip back to this. We're inside this this bullish order block here on the weekly fair value gap. So it could just be a retracement, like I mentioned. So yeah, we'll see if that same phenomenon takes place here in the DXY. We have a fair value gap in here as well. And we're at equilibrium. Okay, so if we flip back to the weekly chart, go from this low to that high, equilibrium's there. And like I mentioned, we have overlapping candles, multiple. So we're in again a low probability condition, very high resistance environment. It's not unreasonable because of all the tariffs and crazy geopolitics taking place right now. We'll see if that changes. But for the most part, we're at equilibrium, right? We have to see what it's going to do outside of these overlapping weekly candles, and see what the bonds and yields are going to do, see what they're going to favor, because that will solidify our assumption in what we believe price is going to do moving ahead. All right, I'm gonna assume though, until something changes, that this is still looking to possibly target buy side. But again, if it just starts to use this as a downside move, this wick here is very concerning for any type of buy side delivery, because it came off of that so aggressively. Generally, that's not a good sign for price to continue in that direction. But again, we have to really see what the yields are going to do from this area, because this large wick to the downside here can have an impact with price responding to the buy side, which would then influence this to continue to march higher. I'll tell you one thing though, if this was to decline here and break this low, bullishness is out the question. Okay, because we would then have a fair value gap here. We also have a fair value gap in here. We have a swing low. Okay, and then we also have new week opening gap in here, and new week opening gap in here as well. So there'd be a lot of reasons for this to lack strength, especially if we saw the yields end up tanking as well as a result. But yeah, if this gets above this fair value gap here, that'd be kind of interesting. Right, we'll see how price uses this. There's a new week opening gap in there as well. We'll see if it gets above that. If not, if it shows massive resistance, if it can't get above the midpoint of this this one here, right, this weekly fair value gap here, that's also indicating weakness. Let's actually take this and let me go to the currencies real quick. Is it the weekly? No, it's a daily. So yeah, let's look at the weekly chart here. Let's look at the highs. Take some of the drawings off. So if you look at these highs here, all right, we look at the highs here on the DXY. Now let's switch over here and see if we can find an S&T between the DXY and the other currencies. Okay, so see if we go to the daily, see if we can find one. So there's not really much of an SMT down here. What I do see is the SMT here at these highs. So that's something that we're going to have to monitor. Because again, that just starts to favor possible weakness. If we would have seen SMT at the lows here, do we have SMT at these lows? We do have SMT at this portion, right? So there was a failure in the GBP USD to break the low, but Euro USD broke the low, which obviously you could see at this point in hindsight triggered price to move higher a bit and give this retracement, right? So again, we're just going to have to monitor how this is going to deliver, right? Again, the bonds and yields, they're going to dictate a lot of what is going to be trusted. At least for now, obviously, this looks like it may want to continue pushing to the downside, at least from this weekly time frame. So we're going to have to see how price behaves. It is a mess, right? It is a mess. If you just look at it, it's a mess. Okay. And I mean, it's been a mess the whole month. You know, it's been, for a lot of people, it's been really difficult, right? And the frequency in terms of trade limits as far as what we've taken has been much lower. But those of you that follow me on Instagram have saw it doesn't matter what condition we're in. Okay. Like I can find something and we can make sense of the intraday lower time frame volatility. But as far as a higher time frame and being confident as far as more longer term perspective, it's not giving us clear evidence. I'm assuming, if we could stay above this swing low here, if it could stay maybe above this fair value gap here as well, that maybe it'll continue. We have relative equal highs up here. We have relative equal highs here as well. So that's pretty interesting. But again, CPI is next week. Everything could change around CPI, NFP, FOMC, Fed speeches. So we go into weeks like this with a lightly held bias. That lightly held bias, at least for what we're doing here, has to do with what we see in the bonds and yields, right? Is the yields going to rally off this fair value gap? Because it still could be argued that this is in a bullish scenario, possibly to push price higher, or is it going to violate this fair value gap and give us more clarity and evidence that price is then going to want to start to seek sell side liquidity, possibly relative equal lows, way down. This is way down here, obviously, so it'll take a while, but will the news events this week lead us to evidence that that's going to fall off and then maybe see this continue to go higher? Or is it going to, like I said, are the yields just going to rally and then this just turn into the fact that it was just a weekly retracement to then go lower, seek the sell side? Again, whatever takes place between those will dictate whether this order block here is going to hold and go higher, or if it's going to fail and break down. I'm telling you this right now, if this low breaks, if it violates this low, I'm not bullish. Because then this will be a run on stops. There'll be a fair value gap that was violated, right? There will be the midpoint of this order block that was violated, and then there'll be a swing low. So that's 3 PD arrays, and then this would turn into a bearish order block, right? So that turns me off of this order block looking to go higher, right? So that is my invalidation scenario. Otherwise, right, if it stays intact and say the yields continue to rally and the bonds maybe look to decline here, then that just keeps this whole structure intact, right? So those are the two scenarios going into this CPI week with DXY. And whatever happens there will dictate what this chooses to do overall. This is just an entire mess. So, you can't really make a solidified argument for one side or another. And it's just, I mean, you could overall look that it's been in a downtrend, overall downtrend. And you can make the argument that if DXY does hold and go higher, then obviously that would allow us to favor shorts in the currencies. And then if we scrub over here to the 3 indices, do this one real quick. Call one a little longer than I wanted it to, but it's okay. But yeah, if we let's look at one at a time. All right, so we have so much sell side liquidity down here. It's literally insane. Once we have confidence that price maybe is going to take a dive, I mean, man, this is going to be such a massive delivery, especially with the fair value gap that's down there. We got an order block, fair value gap, and multiple equal lows. Big time sell side liquidity on the S&P here. So if we get any argument for price to go lower, those are my targets. I mean, that's just obvious, super obvious. But then again, if this order block holds and we look to continue to press on higher, this is the weekly chart. Okay, so each high on each candle is a weekly high. Each low is a weekly low. Depending on what direction it wants to go, they turn into targets, right? If this is going to be a bullish run higher, the next weekly candle, if it's going to run higher and maybe attack the equal highs up here, before it gets there, it has this high, and this high to target and frame a setup off of. And if it's going to drop lower, say, for whatever reason, maybe it wants to decline because DXY is strong or something, then we have the previous week's high here, previous week's low here, previous week's low here, relative equal lows, and then of course we got the fair value gap down there. But yeah, we'll see what happens. If DXY is going to stay going higher, then this is going to turn. We'll start to see some weakness in the indices. All right. For right now, we're just in a range. So making a very demanding argument for whichever side, it could or couldn't happen. We're in a 50-50 environment because of the range-bound consolidation. We've been in literally since, November of 2024, all the way up until now. It's just been very, very questionable as far as what it's trying to do. Then we got tariff things and other geopolitical stuff. It's just been trying to price these things into the market, and the market's been having somewhat of a hard time deciding what's good or what's going to be bad or whatever the case may be, and how that's going to influence what's going to take place in the market. That'll clear up, obviously. That happens from time to time. Things get slow and sloppy and don't really do much from time to time, but doesn't mean there's no opportunity. It just means, again, you go in there lowering your risk, don't demand too much, and just mellow your expectations. Don't force anything, because if you do take a bunch of losses and the conditions are what they are right now, you're going to look back 2-3 years later and think, wow, I shouldn't have taken losses in those types of environments. I shouldn't have been so overzealous to try to push myself too hard in a condition that clearly showed red flags of high resistance. All right. But again, there's an argument for this order block to hold and possibly go higher. That would then target these highs up here as it was to push higher if that was going to be the case. If we switch down to the daily chart, there's just a ton of gaps everywhere, right? Gap here, gap there. So price is very much sloppy. We're just in a range. Right? You go from this high to that low. If we stay inside that range, it's just going to keep bouncing around like ping pong. And it's going to keep sweeping buy side, sweep. Look what it's been doing. Took buy side, or took sell side here, ran up, took buy side, came back down, took sell side here, took it again here, took, part of the buy side up here. It did kind of layer out buy side liquidity up here. So we do have, we do have some buy side liquidity up here if it is going to target buy side. But again, we're going to have to see what CPI is going to do, what the Fed speech is going to do. We're going to have to see what the interest rate markets are going to do, and then how that's going to impact the DXY, which will then influence which side of the market is going to be trustworthy within this. I don't have a solidified, okay, if it breaks down below this level, it's going to do this, right? I could say if it breaks the low down here, that's way far. So if I'm going to make a decision based on narrative and bias, when it gets down to here, I'm going to be waiting a while. Okay. So going into the week, I'm already factoring in that I'm going to have to be navigating intraday volatility, session liquidity, aside from, keeping this in mind, obviously. I'm going to more or less be focused more on what the session liquidity is going to be doing, more near term, maybe even 1 hour highs and lows within the context of, some of these higher time frame levels, like the gaps here, some of the new week opening gap levels, the new day opening gaps that form, regular trading hours gaps that form, previous day's highs and lows. Those are going to be a lot of my main focuses, just because the weekly chart doesn't necessarily, the weekly and the daily, they just look so nasty. Oh, remember what I said about what was it? I think it was the DXY here. The overlapping candles were at equilibrium from this high to that low in the weekly chart. All that's leading us to high resistance. Well, you take that over to this market and you can see all that stuff is applied to this as well. You know, it's very much overlapping. When it does that, you're in high resistance. It's not that you can't trade in high resistance and make money. The question is, are you disciplined enough to take a loss and stop? Or are you disciplined enough to take a trade, make 20 points and get out and be done for the day and not force yourself to do too much? Because if you can't say that confidently, that you can control yourself in those ways, you don't need to be trading to this week because of the current conditions. See, we have a lot of landmines ready to blow up on top of the fact that price is doing and showing characteristics that are low probability, high resistance environments. It's a scalper's market. It's not, let me catch 100 points to the upside and it's going to be very smooth. You know, my model and opportunities are going to form picture perfect, clear. You know, it's not an environment that promotes that idea. It may have a couple of them nested in there, you know, or it may, you know, be very, very sloppy, present the opportunity and then just blast off so quickly that you can't even take advantage of it. You know, and if that does happen, what are you going to do? Are you going to chase it just for it to possibly run the risk of running back on you, stopping you out, and then pissing you off? Right? It's up to you. How do you manage those situations? You got to acknowledge if those types of things are a problem and then set up rules to prevent yourself from being totally destroyed in times like this. Because this is a time that's very much ready for people to blow their accounts. Okay, so just keep that in mind. So again, we're going to come in lightly. Keep in mind all the things we talked about with the bonds, yields, DXY, the other currencies here. We're in a high resistance environment. It's going to be very impactful what CPI is going to do because that's going to indicate, in my opinion, what price is probably going to do for the coming, couple weeks. Because CPI, NFP, FOMC, like I mentioned earlier, generally those are trigger points for particular moves to take place in the higher time frame. So yeah, so keep that stuff in mind. All right, if you guys got any questions, let me know in the chat. Otherwise, we're going to move on to the NASDAQ, and we will put a ribbon on it. All right, so... All right. So if we look at the NASDAQ, I mean, we got the same situation. All right, we got relative equal lows, relative equal highs here. We're back in, if you go from this high to that low, right? If we measure out from this high to that low, look around the camera real quick. Go from that high to that low, pull up the equilibrium, or just the dealing range identifying indicator, right? The fib placement to show us where equilibrium's at. We could see how price has just been bouncing back and forth, taking buy side, taking sell side, right? Taking buy side back to, possibly taking sell side again. Notice how the week closed right at equilibrium. That's the midpoint of this high up here to the low. We closed right at equilibrium in here, right? So because that's the case, if and going back to what I was talking about earlier about when price consolidates, if it's a lot of overlapping higher time frame candles, if it's bouncing around between new week opening gaps and just not breaking out at all, if there's consolidation inside of the bonds and yields, or there's a lack of clarity and one-sided direction in the bonds and yields, if there is a ton of news coming out, right? If there's a cracking correlation between just the overall risk on, risk off behavior between all the markets and all the sectors, from commodities, stocks, futures, or currencies, and maybe even some of the other commodities, right? Like wheat and silver all those things you could look at. I don't really look at all those types of assets. I mainly look at or take a glance at gold. I take a glance at foreign currencies, GBP USD, Euro USD. I look at obviously DXY. I look at the indices, and pretty much that's it, right? You just look at those, get a feel for what those are doing, and then obviously you can get a feel for what the overall market's looking like. And then if it's all cracked in correlation, things aren't going how they should in terms of the relationships, then obviously that's a problem. And then if you add this stuff to it, right, you figure out where the range is that you're working within, break that down, find equilibrium, identify what the behavior is like. Is it all consolidating? Are we bouncing around new week opening gaps? Maybe we're presenting a bunch of gaps in price and we're just stuck between them. Also hovering at equilibrium. All those things lead you to identifying low probability, high resistance environments. So yeah. So in this case, as far as what we're looking at here for the NASDAQ, I mean, we're in a 50-50 environment. And again, we can kind of increase our opinion as far as what could take place, even with price looking all sloppy like this, depending on what the bonds and yields do. Because again, these dictate where most assets will be headed, at least the U.S. assets, and the assets attached to the U.S. dollar. Like the bond yields. The reason the bond yields dictate a lot of times or has an impact on things like the DXY is because the yield market dictates where that currency is going to go. And then the bond yields, or the bond T-notes, right, the T-bond futures, this will assist us in understanding where the foreign currencies will go, because it's attached to the U.S. dollar. The GBP USD is attached to the US dollar. Euro USD is attached to the US dollar. So whatever happens to the US dollar and in the interest rate markets relating to the DXY, that will impact what happens between these foreign currencies, these assets here, right? So again, all this stuff, hopefully it doesn't seem confusing. Hopefully the process is, straight to the point. Hopefully you guys have been noting down some of the high resistance, low resistance ideas that I just been letting you guys know about. Because again, I mentioned this a couple of times in this call today, that situational awareness is critical. When should you trade? When should you not trade? I touched on this a little bit as well inside the other call I did 2 weeks ago as well, and in most of the other calls I've done in the last 6 months, because it's just that important. It's so vital, very important for you to understand how to navigate, understand when to trade, when not to trade, when to push, when not to push, when things are more risky, high resistance, when things are more fruitful, more likely to expand and be one-sided. What liquidity levels are important, right? We talked about that a little bit today. Those things never change, and again, the more systematic you could be, the more calculated you could be, the more knowledgeable you could be as far as what indicates what in terms of the technicals, the better you'll be. You know what I mean? So yeah, I pretty much got through everything I wanted to discuss, right? Remember, in your own chart, you want to make sure you label previous month's highs and lows, previous week's highs and lows that are close in proximity to where we're at. You want to find Friday's high and low, because that's going to be important for today and tomorrow's trading. The previous Friday, because that high and low, that's the most near-term liquidity pools. The way you have put everything together, you are prepared and go with the trend in the markets. Hell yeah, bro. And not only am I prepared, I'm trying to make sure that y'all are prepared too. And y'all can do it on your own. That's the key. That's so critical. Because when you have that empowerment to be able to do it on your own, then you can just, you can just decide to come here and hang out. We could just hang out with each other and bounce ideas off each other when it comes to that at some point. Yeah, that's the goal, right? Confusion to clarity. Get all you guys understanding what is important. Doesn't matter what you utilize. I didn't mention any entry tactics, any other stuff. It's all the preparation that allows us to eventually get to a determination as far as what decision we should make, what direction price is going to go, and why, what influences that. Not just me saying, oh, I think it's going to go here or there because there's a high there or a low there. You know, there's a why, there's logic and science behind why I'm making decisions, why I say price is going to go to a particular level, and it's consistent, it's repeatable, and happens every single day, every week, and there's been just so much evidence of it. It's just literally insane. And many students like Tony have went and applied it. Many students in my private community, almost pretty much all of them, have seen this on a regular basis, and they also apply it, and there's no going back. There's no denying it. There's no thinking, oh, this will never work. It 100% works. The real question is, are you going to apply things properly? Are you going to follow the rules? Will you be disciplined? And are you going to continuously grow and develop the mindset you need that's required to be a trader that is profitable? You know, and everybody could do it. But it's all up to you. And when you get there, your success is your success. You know, anyone that helps you may have played a role, but at the end of the day, you know, once you get to levels of success you're reaching for, even the small wins, you want to make sure that you congratulate and celebrate yourself, because hundreds, if not thousands of people probably quit trading today. And it happens every day. Thousands of people start, quit. But the fact that we stay here, we get put through the fire and never lose hope and continuously see where we need to improve, you know, continuously be honest with ourselves, you know, and all the stuff that we talked about today. Those are going to be the assets and things that keep us in this industry and get us to where we're trying to go, while thousands of people a day quit. You know, so most of the time, the separation between those that fail in this industry and those who succeed, the people that succeed have tried more than the people that have quit have failed. You know, they say the master has failed more than the student has ever tried. You know, and that couldn't be more relevant in this industry. You know, so just think about that, you guys. Just know someone else quit today, hundreds if not thousands, and you're still here, and you're in a place where you're studying information that proves itself. You know, I point things out, you can go look at it yourself, and it's literally undeniable, the things that we talk about, the things that are taught in the smart money trading community. You know, so yeah. So I won't hold you guys for too much longer. A lot of you guys probably got some stuff to do, with like Super Bowl and stuff like that today. But I'm grateful that you guys gave me your time. Like I always say, there's so many people on the internet, so many people you can, you know, lend your time to, yet you've chosen to lend your time to me and hang out with me. And I couldn't be more grateful. So thank you guys for your time. I hope you guys got value. If you haven't liked the video or if you haven't subscribed to the channel, definitely go do that. If you have any questions, let me know in the comments. You know, follow me on Instagram as well. We could go back and forth in DMs. I talk to a lot of people on a daily basis on Instagram in my DMs. And I'm grateful for those that reach out there as well. But yeah, if you guys have any concerns, questions, or anything, definitely let me know. And again, if you haven't liked the video or subscribed to the channel, definitely do so. Share with a friend you think that can get some value from this type of content and the things we do here. But yeah, other than that, you guys, I hope you have a wonderful, wonderful rest of your weekend. And I will be talking to you guys for our first YouTube live trading call for the year on Tuesday. Right? So I will see y'all then. God bless, and you guys have a wonderful rest.